Safe harbor. What is it? And how can knowing what it means save you thousands of dollars? Safe harbor in terms of taxes is the clause or provision that exempts an individual from financial penalties if certain conditions are met. In the terms of the IRS and the state that you pay taxes in, it's an important provision to understand. If you understand how to ensure that you pay enough taxes during the year to meet the safe harbor conditions, you won't be subject to any penalties for late or underpayment of your estimates. To avoid any underpayment penalties throughout the year, through withholdings or estimates, you and your spouse must pay in the lower of 90% of the tax shown on the current year's tax return or 110% of the tax shown on the return for the previous year. Remember, your taxable income is combined with your spouse, and your spouse's Fed tax withholding on their W-2 factors into this calculation too. Your state might have slightly different percentages for the amount of tax they want paid in, but the IRS percentages are a pretty good representation for what you should be using for your state estimated tax payments too. Estimates should be paid quarterly, which is usually why your tax professional will give you quarterly estimates for the next year when finishing your tax return for the previous year. As long as you meet those safe harbor conditions, you can guarantee that you're not going to be subject to any penalties for not paying your tax in on time.